Good morning. I'll try to just speak so I can wander around. At times I'll be pointing at the slideshow up close and personal. So can everyone hear me okay in the back? Kind of used to yelling at classes. Hi, Dale. So when Stu called and said, would you like to give a talk today? I said, well, yeah, that's kind of interesting, but farmland owners have an awful lot of very specific knowledge, and I'm not sure what I'm going to contribute. And then he says, you know, and on top of that, it's going to be the morning after the election, so maybe up to about half of the room might be disappointed or more, and you know, it could be a grumpy crowd and all of this. He said, so let's look for something that at least you have in common. He said, so do you agree with Obama on these things? Not completely. Do you agree with Romney on the, not the. So he's really searching for a way to get me kind of wired into this crowd. And he said, well, you know, the basics, do at least support free speech? And I said, well, of course. He said, well, I'd like to give you have you give another one. So, so that's what we're going to do today is look through some materials, try to understand where the markets are, and put it in the context of where your next dollar might go or how to evaluate the dollars you already have invested. Some setup to this, and part of this is very stylized and part of this is real. We have had enormous numbers of folks who will call us and say, well, what about the bubble? Are we in a bubble? And Sheila Bair of the FDIC said something about a farmland bubble, and the regulators scurried off and studied it. And then Robert Schiller of Case-Shiller Index said something about farmland's his dark horse for the next bubble, and people ran off and studied a bit. And then the institutional investors came around kind of in droves and said, well, what should we do? What should we do? Is this a bubble? Should we try to change our holdings? And ran off and scurried around a bit. And then the drought happens, and then prices go up, and then we have stocks too low, and then we have farm policy that's still perhaps going to get passed, maybe not. And there's sort of this concern du jour, right? So what do we do to evaluate farmland as an investment? The setup seems really easy. You look at the money invested and the rate of return. And in addition to the rate of return, you have to be very concerned about the variability in the rate of return and relative to other assets. So we'll look at that. But we've had incredibly broad interest by institutional investors. Without a big stretch, let me give you a little snippet of a phone call I had earlier this year, actually previous year, calendar year, where somebody called and said, well, my boss tells me that I need to help manage some investments in farmland. We're a fund and we have these kind of characteristics. Says, so I'm supposed to go buy some farmland. He says, so what's the ticker symbol for farmland again? So the institutional investors come in all kinds. You look at the folks like TIAA-CREF. They have a fully engaged large group of people managing it. You have hedge funds who on a day-to-day basis may say, well, we want to buy $20 million of something, and something all the way in between. You have some very well-developed institutional investors, some very uninformed street-style institutional investors, and you have to gauge very carefully what their increased interest means to the market. Traditional investors and individuals likewise have been just really paying attention to the market because, frankly, after 2008, there was blood on the streets and every other kind of investment, and farmland looked really good. Stable, long-term, reasonably high returns. And then owners and operators have had a historic inability to separate their thoughts. So owner-operators think of the engagement and the ownership of the asset as part and parcel to their ability to farm it. Owners who are thinking about rate of return on an invested pocket of money think somewhat differently about this question. So what we want to do is talk about it as an investment, though, very simply as an investment. And this is a really simple idea. We're going to measure rates of return, and we're going to look at rates of return relative to other assets, and we're going to look at variability in return, which really does matter, by the way, and then try to say something about how desirable it looks relative to other things. The punchline will be markets work pretty well. There is, however, one big equity puzzle, and that is that farmland is in a very strange market. Manufacturing America is about 66% debt. Farmland, there's just almost no debt supporting the market in aggregate, but people who do have debt can sometimes have 50 to 60% debt in a parcel. So it doesn't look like everything else where you can buy and sell shares of it independent of the leverage in the asset. This turns out to be a very fundamental difference between other kinds of investments. To try to get my kids interested in money, we set up these little accounts, and my son can go, and my 18-year-old son can go online and buy and sell a share of Nike for $6, right? So his transaction cost in and out, and that's kind of how he has dwindled his initial investment down. He likes to follow the things like that. But you can't go and buy and sell a share of farmland for $6. Transaction costs are high. It's hard to locate the market. So some of that puzzle will be hard. And then the final thing is, what's the rate of return on farmland from today till tomorrow? That's a complicated question we aren't used to asking. What's the rate of return on a bond from today till tomorrow? Well, I can look that up in 6 clicks. We're all carrying around the Wall Street Journal in our pocket now. So the rate of return has to be considered on an annual basis in farmland at minimum. So we have to look at the returns to other investments differently, given that farmland returns are very, very lumpy in time. They only happen once a year. And they're very, very slow through time to change and affect the value of the underlying asset. So it's a really different, very different asset. Really fun. Okay, 2 great quotes. We have 2 great sources of profit in farming. First, the rise in the value of land, and second, profit on production of farm crops. The first had been the chief source. Now, notice, this is a quote from 1886. Not 2010, not 2002, where we have had the Fed. I see Dave Opedal is on the program. Everybody has agreed. If you survey values of land, it's gone up and up. You guys have been involved with the Illinois Society. The fantastic publication that's documented the incredible increase in value through time recently. This is true, but it's always been true. Secondly, it's very difficult to grab land. The area of desirable farmland is relatively small. Number of tenant farmers must certainly increase. Again, this is 1886. It still describes the market today. I think that's rather profound, that the number of tenant land operators must increase. Okay? So that's why we're in this room. How do you manage the return when the operator's income is separated from the owner's income? We'll concentrate on the owner's income. So here's some background data, and all of this will be on the web, and we have actually an interactive version of this one at FarmDoc as well. And like the lease rates question at our FarmDoc website, we have pretty good documentation of lease rates around the state by quality of land and so on. And this is done every 10 years completely by USDA and every year with forecasts. So I just did it by decade to show some interesting things. We're over a $2 trillion farmland market and only 11% debt. Again, remember, manufacturing America is about 66%. So we could somehow lever up the returns. And if you remember some experiences in finance, probably when you add leverage, you often increase the ROE. You don't affect the ROA. Return on assets stays the same. But you can gain a higher total return to your equity invested if there's leverage. But most landowners, turns out, don't have any leverage. They just own it outright. So ROEs equal ROA. And real estate is 84. Well, after you update this for 2011 and 2012, land is more than 85% of the total value of the assets in the sector. Again, there's no sector that I can find that's that concentrated in one sliver of the assets in its sector. Okay, so here's some interesting slides, and you have to keep your eyes open the whole time. So if you're tired, yawn now, and then watch closely. So there's Missouri, Wisconsin, Iowa, Indiana, Minnesota, Illinois. Okay? Now, what did you notice? The picture didn't change. Moved slightly. It just moved slightly. The left-hand scale, however, did change. This is USDA average numbers, so you can kind of, times 2 if you want to look at this part of Illinois, and times 2 for what you'd think of as straight-out productive farmland. This is an average across all areas and has some lag in it. What's interesting is it doesn't matter where you look at it, the story's been the same, the pattern's been the same. If we go backwards again, I'll sort of show you that what's really changing is the scale on the left-hand side, not the pattern. Through the long period from the 70s till now, we don't have final 2012 yet, we have about a 6% continuously compounded rate of appreciation. Joel and others pointed out that we have about a 4% annual income, so this looks pretty good. 9.8 compared to your CDs. This is really why we have so much interest in farmland as an investment. Farmland value versus income. And again, some stories that I think are really important when we get to the punchline slides near the end. Rents as a percentage, this is on a scale where if you had a 5% cap rate, 20 times this scale equals this scale. So very much like Joel presented it, if you had a 5% cost of money, 5% discount rate, and you had this income, what would you look at as the value you should be able to pay today for something with income like this? So cash rent, if you think of cash rent, this is actually cash rent minus property taxes. Don't subtract out anything else. Some people will argue about insurance and so on. But this is cash rent minus property taxes. Those are the rental numbers. You notice they haven't gone up as fast as farmland values. So there are two possible explanations. We have a bubble, or markets are rational and the capitalization rate has changed. Okay? I favor the latter interpretation. The ratio between rents and farmland has not maintained its historic pattern. So people are willing to accept a lower capitalization rate or pay more per dollar of future income. Very straightforward relationship. And again, I put up Illinois and Indiana, had Iowa on for where I was Monday. I mean, these pictures are the same, regardless of how you do them. The scales change a little bit. Major asset classes. This is one that we keep putting out, and we keep track of about 60 different individual assets, along with farmland at every state level that has meaningful data. So there are a few, we don't really look at Connecticut or New Jersey, but every agricultural state, New Jersey actually does have some farmland. And then we have U.S. averages, which are acre-weighted, and we have another average, which is just state-weighted. And then Dow Jones, Europe, so equities in Europe, East Asia, Far East. We think of the Tigers and the Rim countries as being another plausible place investors will put their money. Gold has become the darling lately. People always want to look at gold. REITs, another real estate investment. So in addition to these, we keep just a great big bevy of other alternative investments so we can say at any point in time or any interval of time, and that's important, what do farmland returns look like relative to other things? Okay? The items below this line are all treasuries or related commercial paper or corporate debt instruments. If it starts with a T, it's a treasury, so treasury bills, secondary market, 3-month. I know my acronyms are short and compact there, but that's 3-month money, 10-year money, kind of the breakpoint between investment grade and non-investment grade bonds, high-grade corporates, lower-grade corporates, commercial paper. And then the last two are fascinating, the consumer price index and the producer price index. Joel made several points about inflation, others have in the past. I'm not sure if the CPI or the PPI is a better index when you're looking at a productive asset. Probably, perhaps the PPI. But it'll turn out the correlations are the same. So we'll put this up, and people always say something about, well, the 80s. The only period that farmland had a decline in value was the 80s. So what's the impact of the 80s? And so we'll take out the 80s, or we'll put in the 80s, or we'll change the intervals of time. And except if you start in the 80s and end in the 80s, these patterns are fairly stable. After the annual rate of return, I gave a standard deviation or the amount of variability. Now this matters. If you had $100 and lost 50%, you have $50, true? If you had $50 and earned 50%, you have $75, right? The average of those two rates of return was 0. The more variable it is, the more the impact of the denominator problem shows up. So you want low variance for lots of other reasons as well, but low variability is a good thing, and the ratio of the return to the standard deviation is called the coefficient of variation. Smaller numbers are better. This tells you how much risk per unit of return you had to be subjected to. We had a question in the back?
Yes, sir. On the previous slide, as a landowner looking to maximize the return for a cash rent, are you tying the cash rent, or do you suggest tying the cash rent to the valuation of the land or to the return as far as bushels per acre, or to the price, the average price at the elevator or the processor? So
great question. To repeat, generally, as a landowner, how would you, I'll try to paraphrase, tell me if I get it wrong. How would you tie the rental agreement to the value of land, the price of the commodities, or some other rate of return number you could generate from the land?
Correct.
I'm a big fan of the flexible cash lease. Share leases have some shared risk relationships. Flex cash leases carry much of that as well. I'm also a big fan of beginning to tie the cash rent relationship to something including insurance usage. So crop insurance has become one of the can't ignore it kind of elephants in the corner of the room. And there are ways of tying it to minimums that you can get from using crop insurance in a judicious way and allowing that minimum floor that it can create to be shared with the landowner. So I'm personally a fan of that. They're a slightly more complicated set of leases than might have been historically most popular. Illinois, of course, again, I go through this very quickly, but Illinois has a really good database we keep at the FarmDoc website on cash rents and flex cash leases and some forms and such. So for the interest of time, I'll continue and kind of point you there. Okay. So, and again, This is sort of an hour presentation in a half hour, so I have to speak twice as fast as I should. But there are some issues about returning this that I want to just remind you that we're going to look at some pictures that help us understand how volatile returns are as well, because the volatility really matters. There's also this indexing problem. How do you buy a share of farmland? How do you get into this relative to something else when they're generally lumpy? It's really hard to buy my next $10 of farmland. I can buy a couple $100,000 at a time maybe, but it's very lumpy. And how we treat time does influence things. And finally, transaction costs. So even though you saw those numbers, remember that you can't buy and sell farmland every day. You can get in and out of the Dow every day for nothing, effectively nothing. So here's a great summary of how it's performed relative to other things in terms of the correlation. The correlation says, do things move together or do they move in opposite ways? And if you have farmland and financial investments, you want them to move opposite ways so the total stays fairly constant. If you have only one asset, you don't want it to move much. If you have lots of assets, you can afford more diversification issues. And in this case, what's interesting is no matter what period we look at, we discover that farmland, and I'm using Illinois in this case, farmland is negatively correlated with equities returns. Now, this is over long periods of time. And if you measure short periods, the statistics change and these move in and out a little bit. But the general story is farmland doesn't move the same direction relative to equities that equities move, and vice versa. Great diversifying idea. Likewise, it's fairly highly correlated with inflation measures. The CPI, the PPI, these are always generally positive bars when we put them up. And finally, off the scale, you notice the end doesn't look the same no matter what other measure of farmland you use. They tend to be highly related. So when the price of corn goes up, generally everybody gets a higher price of corn. So you don't have these sort of income effects that separate the returns to the individual investments like they do with other equities. You bought a share of GM, a share of Ford, a share of Honda, Toyota, Hyundai, Kia. So you diversify across car companies. Their returns don't move together as well. Buy farmland and buy more farmland, you haven't diversified all that much. Okay, I'm going to skip that one for now. This is a really neat summary in my opinion because it says held through the end of 2011. And what you expect is if we bought everything in 1970, the average rates of return and this sort of averaged until now will be what they are. So farmland looks pretty good, but the REITs do a little better, our US average does a little better. And there are periods of time where it moves around, but farmland, the blue line, stays near the top. And most importantly, when you get to these exceptional periods of return time, people are excited about REITs right now, excited about gold. Okay, so you had a couple years where you got more. You have a couple years where you got a lot less. The volatility in farmland smooths itself out fairly quickly. This is a very interesting result. And there's something that should be consumed up close and personal, I realize, but if you want to understand how to look at farmland returns through time, look at the pattern on this map. So this is a buy as of date, sell as of date. So if you bought in 85 and sold in 86, you get that red dot. The one period of time where you could lose money. 85, 86, where it's below yellow or the background color, you've lost money. Where it's green, you've made more than average. Where it's yellow, you've made about the average rate of return. So what's notable about this pattern through time? And of course, the diagonal here is a one-year holding period. So we can look at, if you wanted to compare farmland to other things on a one-year holding period, you look down this diagonal. If you want to look at a two-year holding period, you look one step in. Three-year holding period, 3 steps in, all the way out to the final number. We have a 41-year holding period number. But you can only measure one 41-year period in our data. So you only get one chance to look at that. The variability of your returns can be understood by looking at the map. The picture over here, again, I know it's a very complex thing, but it only has one stalactite, one thing penetrating the zero. That one dip down that's below the yellow happens in the early 80s. So this is another, again, very technical graph, but I want to have you appreciate what the patterns mean. This is what happens if you measure the rates of return and the rate at which they converge to their long-run average. So as this sort of trumpet-shaped thing gets narrow faster, and the length of time at the end that it's squiggly, summarize the variability regardless of how you measure the data. You want things to come into a cone quickly. and not spread out too much at the end. Okay? So farmland looks like that. Equities, there's lots of short periods where we look down this diagonal, we make money, we lose money, we have the tech bubbles, we have 70s, we have 80s, we have all kinds of little ups and downs. And look what happens if you invest in equities. It doesn't smooth out as quickly, and you don't get this convergence on its long-term sort of variability very quickly. REITs, likewise, because people like to look at farmland compared to other real estate investments because they're easier to make. You can go find a REIT fund and you can invest in that. And if you have a retirement plan, you can always check the box for a REIT kind of investment. And again, it just doesn't look like farmland. Okay, again, I know if this is at all interesting, come sign up for a class at U of I, and we can do the same set of slides in 15 weeks. Here's a summary graph that says if we just put on a single page the standard deviation of returns, so more is bad. The further to the right, the more variable they are. And return up the vertical axis is good. The higher it is, the better off you are. So you want to point to the left and to the top. Farmland is right up here if we look at today's statistics. Treasuries and corporate debt are, as you guess, lower variability, but also lower return. Gold, REITs, Dow Jones, and equities tend to cluster up here and to the right. I think this is a fascinating summary of farmland returns. If you happen to own farmland, you're brilliant. It looks like you could have anticipated this and you made the right investment. If we move the sample period around, what happens is these numbers bounce up and down, but they still stay relatively above and to the right of these numbers and relatively to the left of these elements. So less risky than equity investments. And this one's hard to interpret except that what you want to concentrate on is this blue line says, is there any level of risk at which you wouldn't own farmland? And it turns out the punchline is kind of no. It behaves a little bit like a fixed income position in your portfolio. So relative to the other investments you have, having farmland included with it, this is a mixture of all the things that are possible, and then this is called the efficient set. The things you would want to hold to stay risk efficient always include farmland. And again, this is the great frustration to the institutional fund managers because they can't figure out how to put farmland into it. Now, here's some great punchline things to try to get kind of to the end of the period. You know, I guess you can vote with your feet at some point if we run out of time, but we have about 5 to 8 minutes left. Okay. So does the farmland market make sense? And these are a couple of great summary graphs that help you understand my view of where we are in the cycle of farmland returns. So this is again through time. This is the sort of an interest rate, and if we take the 10-year treasury rate, constant maturity treasury rate, so go to the market every day. This is a number you can look up. It's in your, if you have an iPhone, it's in your pocket right now. And then compare that to the Illinois value of dividing rent minus taxes paid by the sale price of that parcel that was generating it, or the current market value. You get the greenish colored line. So I'm sorry, I reversed my statement. In the 80s, we got this kind of divergence between the implied value and the cap rate that was required to finance it. What we're seeing right now is just a case where the cap rates are going down, so the amount you're willing to pay for future dollar of income should be going up. Is that a bubble? It doesn't look like it to me on the basis of that. Some great quotes from Buffett and others that say, you know, bubble is really when the fundamental value and the market price get out of sync with each other. This is a measure of the fundamental value. When it gets out of sync with each other, it's capitalized at the wrong rate, in essence. You aren't earning enough on it for the risk that it involves. Then you have a bubble. Then you can have things move back together. If we convert that straight out to values using the same sort of algebra, implied that the amount you'll pay for an asset is its discounted value of its future earnings, you get exactly this same picture again. And where would you say it looks like there's a bubble? Well, in the 80s, I can say things weren't in sync. What I can say now is things look pretty much in sync, except that this is what I worry about. This is a picture Again, I know I at least have won the award for the most complex graphics this morning. This is a picture that every day we take a yield curve snapshot. We say, what would it cost to borrow money for 1 day, 2 days, 3 days, 1 month, 3 months, 6 months, 1 year, 2 years, 5, 7, 10, 15, 20, and 30 years. So it's a big database. We find out what it costs to borrow money for terms of that length each day, and then plot it. And it's a very cool picture. Okay? So this front surface, the line on top at any day is the yield curve that day. So if you were to go to the market today, this front is a little bit, this is a couple months old now, but it doesn't look much different. If you borrowed money for 1 month, you pay effectively 0. Out to 3 months, you pay effectively 0. Borrow for 30 years, you pay what that line turns out to be, 3 3/4 on a 30-year sort of compounded basis for Treasury money. So this is also what the banks convert to pay you on your CDs. Drop money in a CD and you have that minus the cost of lending you money. What's happened is when we keep having quantitative easing programs, we're really trying to bring the short end up relative to the long term, and what's happened is the short term hasn't moved, the long term's come down. So we have this interest rate scenario, which I refer to as the puddle at the short end of the yield curve. A puddle of money in the lending community at the short end of the yield curve. And no particularly positive prospects out on the long-term end. So I hope if you had a mortgage, you refinanced it this year. You know, the banks made more money, they increased your spread, their spread, and they dropped the nominal interest rate they're charging you. Quantitative easing 1, quantitative easing 2, and QE3, or the Operation Twist, try to buy up, twist long end and short-term parts of the yield curve, don't seem to have a big effect. We haven't found out how that's going to affect things. So this is the big risk in my mind that's left in the investments in farmland. We have a picture up at the top that shows the land value by their rent and net cap rate. So Central Illinois, Drummer Flanagan, high-valued land, your $400 cash rent might in fact be cheap. Southern Illinois and some timber soils or something, $200 rent might actually be expensive. There's quality adjusted differences. Don was exactly right. You figure out what it can earn and you change the rent. But this shows what happens if you have $400, $300, or $200 value per year rental land on what the price should be. And that vertical line is the generally close to what's implied as the market cap rate on farmland today. So $400 an acre cash rent ground should sell for around $10,000. Those of you from closer to Iowa probably saw the $21,700 parcel go last week. My guess is that might have been a tad high. I don't think they're growing 400 bushel corn there. $200 an acre ought to sell for $5,000 and so on. But the important thing is to recognize what a different world we're in right now. The bottom one says, what's the percentage change in value if the cap rate were to change? So remember, we're at a really low cap rate, and the previous slide said it's hard to figure out how we're not in that given the Fed's current policy and what's on the new balance sheet of the Fed, the new ballooned up balance sheet of the Fed. What's important is that the sensitivity of value now is at an all-time high. If cap rates go up, values go down by more than they used to. It used to be when we were looking at 7 or 8%, yeah, you got an increase or decrease, yeah, you might have gotten a 2 or 3% blip. Now we're in a position where we might get a 15% change and still stay rationally priced relative to the cap rate.
What's the basis for the 4% cap rate?
It's slightly below 4. The rent divided by value minus some cost of actually owning or transferring the land. So it's an imputed number that is what is the land earning as of today. So, and that's just on an income basis for obvious reasons if you're capitalizing income. Okay? So the difference, a deeper question perhaps than you intended, if there's a difference between the capital gain you expect and the income growth rate, this also gets accentuated. Again, in a 15-week class, we would talk about the growth rate in value versus the growth rate in income. Right now, they're fairly matched. You saw rent wasn't going up quite as fast, but they're fairly matched. So, 2 minutes. Okay. Perfect segue. Only had to talk 300 words per minute to get there. So the sector has really low debt, and the equity is concentrated in the hands of not too many people. So it's really difficult to access farmland investments. I think some of the efforts to do this more broadly, there are groups putting together funds in a good way, and I think it's moving in the right direction. Another comment, though, that I was trying to remember to say is that if you only look at sales prices, if you only look at the 21.7s or the $37,000 transfers, you know, strange things that happen, you can't just look at transfers to know what the value of land that didn't sell is. You kind of have to look at an income number as well, because a lot of times the transfers are between, you know, between two farms that both want it, and that's a fine thing to consume some income and buy land for more than its future income, or developmental paths, or because it lets me use up a machinery complement. Crop insurance. This is, again, I just wanted to remember to say this out loud. I think it's absolutely critical. If you look at what happened this year, we had the drought, and what's it going to do to incomes? Well, the timing was bad, but USDA released a report recently that shows expected income at an all-time high. Okay? Why? Because crop insurance effectively put a fairly substantial floor under what would happen regardless of the yield. And in Illinois, we have this negative relationship between yields and prices that helped out as well. So we now have insured bushels at fairly high prices, and the percentage increase in price was greater than the percentage decline to the floor of the insured bushels. What happens now? The bigger drought, my income will go up even more. It's high transaction costs are a characteristic of this market. I don't know what to do when my son eventually grows up enough to say, how do I buy a share of farmland? Well, I don't know. You know, you pick the wrong parents, I guess. You don't get to get your 1/3 share right away. But the funds are starting to emerge that are building these. As I said, TIAA-CREF has a very admirable project in front. They have a couple billion in farmland, and it's not a bad thing. It's not a good thing. It's just a thing. They have developed a very dedicated and long-term presence in the market, and they're going to have funds that you can buy and sell returns out of a group of farms. This one is my big fear. Somebody tell me the exit strategy for the Fed that doesn't involve inflation or a really long time with this blue puddle at the front end of the yield curve, which is equivalent, frankly. Low productivity and higher inflation are identical. It doesn't matter which form of medicine you take. So if anybody has the magic bullet to know how the Fed is going to get out of their tripled size of actual holdings without creating inflation or reducing productivity, I'd love to hear it, because that's the scare. To me, if you get big inflation and you drive cap rates up, they sort of get tethered together, you drive cap rates up, you could get a relative decline in farmland values. Now here's in case you think I'm the bearer of bad news at that moment, in the 80s, it was a farm-specific crisis. If we have the Fed at the next meetings say, gosh, what we're going to do is we're going to offer for sale all the assets, and, you know, first come, first serve, we're going to do this, and we're going to print money to pay for it, you get inflation. That's an economy-wide problem. That's not a farmland problem. It affects farmland, but it affects everything else too. Farmland just has a very long duration, so its percentage change can be a little bit higher. We have a question here.
You're going on with those cap rates. Can you quantify in any way, shape, or form the value of farmland currently as it relates to the amount of money being printed from QE1 to QE3?
So the question was, could you quantify the value of farmland relative to, in a sense, the stock of money in the economy, or the money supply? No. You can look at its share of...
It's a lot of extra money, it seems to me. It's a lot of extra money chasing yield, okay, and chasing a fixed amount of assets.
Right. What you can say is the amount of liquidity in the economy is at an all-time near high. Okay? So during the bailout periods, there were facilities that may have made it even bigger, but the amount of liquidity, hence a lot of money seeking yield, in a sense, is at an all-time high. Again, I think the transaction costs and the difficulties of buying and selling farmland have prevented a direct spillover. I don't know how to respond much more directly than that. So farmland values have held up relatively well, obviously. Yes?
Yes, sir. The value of the farmland, are you calculating that number based upon the yield or based upon the average sale in, say, a particular county? Or what is like the best way to calculate the value of our acreage in a particular county?
A question was how best to come up with a measure value of farmland in a particular location at a particular time. Is that a fair representation? Yes. These pictures back here, depending on which one I showed, and I apologize for the speed of this today. If we go clear to here, these are USDA average numbers. So once you can look at your value relative to the value of that, you can kind of look it up and multiply by that ratio at any other point in time. So if at the date you sold it, it was twice as valuable, then at the end it's still twice as valuable. This is kind of a multiplier scale. For the slides that I presented later, these were income divided by, so cash rent minus property taxes as an income number divided by the underlying value. And if you divide that by the treasury instead, the 10-year treasury, you get an implied value. So when I have implied values, that's rent divided by the 10-year treasury rate.
Okay, because when I looked at the slide and it showed the average values, the average value for Illinois there is showing $6,000 an acre.
Right.
When you look at, like, say, for example, Farmers National, they
right.
send out weekly monthly periodicals. Their cash rent leases are $550, which is like $250 more than the U of I website.
Right.
And then their prices are for farmland are significantly higher depending upon which county you're in. So if everything's being calculated by value to determine cash rent, as a landowner, I'm just trying to figure out what is the optimum way to calculate that value so I can say, hey, my property is worth $500 an acre, cash rent
right.
$550 or $450.
So again, partly why I'm in favor of the flex cash leases is the standard versions of those model that pretty well. You figure out what the expected yield is on that location, and again, a Drummer Flanagan versus some foresty soil or something is going to be a very different thing. Pardon? The APHs and trend-adjusted APHs come reasonably close, but there are some historic patterns in those that you might do better with a soil productivity number than an APH, in fact. So that's a great idea. That's a start. You can tie it to crop insurance with the APH and then figure that out. So Farmers National sample is different than the average USDA uses across the entire state. Their numbers are different than the FBFM numbers, which we calculate from FBFM cooperators. So all of them are pretty good numbers. It just is kind of a quality internally adjusted. We're getting a lot of high signs here, so I'll kind of cut to the end. If you have questions, feel free to email me or visit us at the FarmDoc website. A lot of good material there as well. Thank you.
Thank you, Bruce.